Okay, so I believe we can start now. So good afternoon, ladies and gentlemen. It's a pleasure welcoming you all to our webinar, The Art of Successful Investment in India. So today's deliberation will be focusing on helping you to understand how to manage investment in India. So our speakers will take you through the India-specific issues in different kind of transactions. Kill portfolio includes a private and strategic equity placement, partner search, merger and acquisition, business and regulatory valuation, financial due diligence, financial modeling, negotiation, and contract structuring. So today, Nitin will cover the Indian investment market and its recent M&A growth, emphasizing the reality of investing in India and successful investment management. He will highlight key consideration for foreign investors and we share his experience with M&A deals, including the reason for failure and the importance of knowing your Indian partner and complying with the key regulations. So before we start, I would just like to share a few pointers for this webinar. So all the participants will be in the listen-only mode during the webinar. So if you have any question or comments, please put them in the question section in the chat box and we will take them at the end of the session. We will also be emailing a link with the recording of the webinar tomorrow. And thank you everyone for joining us today. And Luisa, please over to you.
So thank you, Leah, for the introduction, and pleased to share with Nitin and all the other team this discussion around the art of investing in India. So Yeah, why the art of investing in India? First of all, I would start from this point, is that first, the geography and the diversity of the country is so important, which clearly investing is a match between business and art. So I will start sharing with all the participants a few data about the innovation ecosystem of India and how the startups became scale-ups and became unicorns in the landscape, and how the funds that are behind this startup has been successful over the time. So I think that the starting point would be the time, would be which are the unicorns in India and how much time it takes to become a unicorn, which is clearly one of the shortest in the world if we compare with Europe essentially, and also United States in some cases. But there is a reason why these unicorns became so important and so impacting in such a short term. So we will go through these points. So you will see in the slide that you have a first generation of startups which becomes unicorn in 5 years. And then clearly we have the very well-known Flipkart, which is, the first online supermarkets which exist in India. But that we have a lot of examples of other businesses like CureFit, like Uni Academy, which takes more time to become a unicorn. Then you have a second family of startups, which takes between 3 and 5 years, which is quite exceptional because to become a unicorn and to have such important footprint in the market, in the consumer, in the B2B in a such short term is impressive. So in this category, you find different businesses which are showing that the business model are becoming more and more sophisticated in comparison to the initial business model that takes more than 5 years. So you have, for example, Prisma Care, which is providing very basic cares and surgical intervention. And this company is capitalizing on the upper middle class that is growing in India. And it makes a real difference in the space. And so clearly this company was able to catch up this need of a better healthcare services in India. And so I would say that over the time, both the startups, but also the funds that are behind these startups, were able to have a better focus on what is the customer needs. And also we will understand after to identify uh, appropriate acquisitions in the market, to identify the right acquisitions in the market, and so to buy across the innovation ecosystem in India, the right company to grow up through a build-up strategy, which is a very interesting inspiration for international investors or portfolio companies in funds that wants to expand in the country. So this is a very interesting benchmark. So we have a last family of company which becomes unicorns in less than 3 years, which is quite exceptional. And we can go inside a few names because I think that one of the reasons why these unicorns became so important in a short time is because they respond to market needs, but also they respond to the new values or to the values that for which the global economy is standing for. So they are more sustainable. They are connected to activities that are more sustainable. Come Global Bees. Global Bees is a company which is promoting and supporting brands that are sustainable and in different spaces. And so today, the consumers, especially the new generation, is more conscious on the fact that we need to live, but with respect of the environment and of the social balance. So the aspect of alignment, balance, respect of the environment, of people is inside the new generation. And so this kind of unicorns are the outcome of this new consumers motivation and logic and in the shopping behavior. Then you have another very interesting company which attract my attention, which Mensa, which is a company providing IQ test, so intellectual quotient test, for all generation, for all people, and this is showing how India is interesting really to know, where they are in terms of intellectual performances. And this is absolutely fascinating in observing how this company and the trajectory that this company had over the time. Then you have other success stories which are always aligned to this sustainability values connected to the respect of environment and social balance. So you have Ola Electric, and you have also Farmer Easy, which provide an easier access to all product in pharmaceutical products. So all these unicorns are connected to what I call transformational India, and this is the reason why I always worked with the ecosystem, because everything is transformational, and these three steps is clearly the example of this transformational capacity. Different families of startup became a different family of unicorns, driven by different, I would say, economic arguments, and sustainability is coming more and more. So it's very interesting to see how in a such short term um, this understanding becomes a reality. So yeah, next slide, please. Yeah. So the first concept is that this transformation towards sustainability, and how the startups became unicorn in such short term. The second point is very important and would be inspirational for any international buyer. So I am European, so I know better Europe, but this logic is valuable for any international buyer or company having strategies in India. That very interesting to understand that the contribution of the unicorns in India are not only based on organic growth, uh, but is also based on the capacity to identify in a very large portfolio of startups and very innovative startups that are available in India. So I think that in India you have something like 250, 300 accelerators, which has a very important focus. And so the companies were able to choose among this large portfolio which company could fit in the strategy, in the value. And so they were able to realize 326 mergers and acquisitions inside the country, and transform a startup, a scale up, into a unicorn with a very, very pertinent build up strategy, which will make the difference for both domestic, I would say, landscape, but also to go global and to have something to say outside the borders. So this is a very important point, because essentially, for example, in Europe, we have company which are making build-ups, but not at that speed, and not with the same probably availability or the same view about the startups. So it's very important to understand that the dynamic of the unicorn development is slightly different from Europe, in which organic growth plays a very important role for different reasons. And now what we observe also in Europe is that the groups start to realize more external growth, build up strategies. We have, for example, a company in France named Miro, which has made some acquisitions in India. So we assist to that, but this is intrinsic and a peculiar of the Indian landscape. So the next step and next point of the logic would be that to go inside a few examples of Indian unicorns and which kind of acquisition they have been done. So if we can move to the next slide. Yeah. So I just select a mix of startups of new generation, of previous generation. So Paytm is a very old, we can say very old, Paytm and Flipkart. They are very old companies in terms of unicorns. We know very well, and they are backed by VC, which since the beginning, and this is a very important, they understand that the time to market was quite long, especially in the beginning. Now it's starting to be different, and they support the corporate in studying and monitoring all the market in terms of startups, and identify the right companies to buy. So in the list that you see in this slide, you see the outcome of a very long and deep analysis of the startup and scale up available in the ecosystem, in order to identify the right one to support the build-up strategy and which fit in the corporate strategy. So clearly, Flipkart is a very long story. It takes a lot of time. I think that the investor is Tiger Global, which takes something like 10 years. But because 10 years ago, the first of all, the local consumer didn't have the same purchasing power, and also the availabilities of other startups having a market share, having a technology inside, having a specific approach was not available. So the last 5-6 years for the company has been key. And what has been key is also the mindset of the investor, of the partner, who was able to support the company not only financially, but also in terms of knowledge and intelligence, and supporting all this process. So this is why we are speaking about the art of investing in India. We speak about the art because this is, as the landscape is very large, we need to invest time to analyze which are the best companies to support our expansion plans. And this is why it's important to have the right advisors to do that. In terms of strategy, in terms of technical infrastructure, that could be accountancy, could be fiscal. So this is why we observe this outcome. So as you know, conclusion on of my discussion of the presentation, the the suggestion or recommendation would be that the market, and I always said this since the beginning, the Indian market as and offers tremendous opportunities of build up. So identifying the right company in where you can invest in, and the accelerator, the local VC funds that are now realizing some exits, the accelerators that have now 5, 6, 7 years, you can find a very interesting pipeline. Could be a very powerful deal flow source to expand in the country and to identify the companies having the best practices inside, because they have been supported by professional investors. So, and this is a logic which has a sense for both corporates, funds, institutional investors, foundation, whatever else. So, since the beginning, I always been convinced that the market in India is more a market on that sense rather than exporting something, with some exception. Clearly, there are some exports which have a sense for sure. But I would say that the largest part of the market is a market in which you are part of the ecosystem and you invest in the ecosystem. And you create value alongside this what I call cross-border for cross-fertilization. So if we go to the next slide, yeah. So yeah, the recommendation is this 2-point cross-border cross-fertilization, is saying find the companies in the Indian landscape that fit for the business model, fit the local needs, that can eventually can go global also, and to take into consideration and to dedicate time and energy to what I call cultural legacies. Means that each one of us is the outcome of our own culture, of our own country, our own education system. So our point of observation is very different. So each reality could be observed differently. And this is to create value together, we need to incorporate that point. And once we realize that it cannot be immediately automatically fitting, but the fit will take time. And when we accept this point, the value will be tremendous. And this is why this groups has been so successful, and also foreign groups has been successful. I just had one example, which is quite impressive, that I didn't put in the slide, but it came in my mind during the conversation, is that you have this Belgian family office named Berlinvest, which I know very well since a long time. It's a fund, it's a family office basically, and he had 2 steps to invest in India. He started to invest in local initiatives, in funds, and then they start their own fund. And in their own fund, they were able to seed very interesting companies like Epigamia, which is a company today, is a brand today in the food space. So they clearly implement what we are sharing. So understanding the ecosystem, understanding the needs, and leveraging on the local, I would say, local consumption story with local products, putting inside the best practices, which can come from Europe, from United States, from Asia, from everywhere. But this is I think, the best advice to share with our esteemed participants. So thank you. Thank you for your listening and for your attention.
Thank you. I think thank you, Louisa. Maybe Leah, we can go to the next slide. Louisa, thank you for setting the context for today's conversation. I think very insightful, interesting to hear from somebody. We live it day in, day out, but so interesting to hear the India story from somebody sitting in France, but closely working with India. Before I talk about what are the factors we need to take care about India investment and etc., let's talk about a little bit on the M&A trends because that's what we are essentially talking about. So if we talk about the M&A trends in India for last few years, as we can see that 2021, there was a subdued activity both on the M&A side as well as the private equity side. It was largely due to COVID and also due to the geopolitical situation, the Ukraine war, the inflation. But 22, calendar year 22, we see a major uptick in the deal volume. While the actual deal values, the deal volumes been more or less the same, but from $38 billion M&A activity, it went up to $91 billion in the M&A activity. This was essentially due to some large mega transactions, HDFC's mergers, L&T Mindtree transaction, Adani buying Ambuja. So there are large transactions which have contributed to this trend. But on an overall activity, we do it day in, day out. We can see a huge, uptick in the request demand for the activity, M&A activity in last 7 to 8 months. So 22 is a calendar year, but I'm quite hopeful that 23 calendar year will be even a bigger tower than this. If we were to talk about the distributed between the domestic and the cross-border M&A, as we can see that the cross-border M&A has remained more range bound, but the domestic activity, because of these large M&A transactions, which I mentioned between domestic transactions, it has gone up from $24 billion to $71 billion. The 18 billion of the outbound actually is a little bit of a misnomer because it includes a huge investment by Adani to buy the shares of Ambuja from Holcim. So it's been categorized as an outbound, but it's essentially a domestic India transaction. If we were to talk about which sectors in which people have been doing cross-border M&A, we are talking more essentially across border today, then technology, healthcare, utility, and telecom will take a large chunk of the pie. I think there is no secret that technology constitutes to be a very large portion for the Indian companies. All big Indian IT companies are making acquisitions outside to acquire talent, customers, and you just talked about 326 M&A transactions in the startup space, which are essentially largely filling into the technology pie. On the healthcare side, there was one large transaction. Biocon made an acquisition in US last year for $6 billion, and that's why you see a big chunk of the cross-border M&A happening on the healthcare side. But technology, healthcare, utility, telecom, and energy, which is the renewable energy, solar, wind, we are seeing a lot of interest and inquiries from our clients who are looking to invest in these sectors. Next slide, please. So why India? Now the important question is why India? Of course, we've been all talking about good things. But if just I was trying to pin down why a foreign investor is looking at investment into India today. One of the main factors is a very strong, stable political situation. The current Modi government is finishing its 2 term. Next year, we are due for election. Unless and until something really goes wrong from here, there's a big chance that the government will come back. It gives a lot of stability for the people who are making an investment decision into India. I remember 2 decades back when there was a coalition government, every 2 years the government was changing. People who are sitting outside, they are little reluctant to take long-term bets on a company or a country which is not having a stable political situation. It augurs really well for an economic stability of the country. I think GDP is no secret. Again, India is the 5th largest GDP, recently overtaken UK in terms of the GDP size. Various estimates keep on floating here and there, but safely between 6 to 7% GDP growth is predicted for coming years, which is actually the highest in the world, even higher than China. What contributes to this GDP is also a very large working population. With a 1.4 billion population today, 2/3 of the Indian population is in the working class, and almost half of it is actually employed. So around 580 million people are actually employed, which is a huge population which is contributing to this GDP. And the median age for India is 28 years. Now compare it to 38 years of a median age for China. It's a big upside for the population who will be contributing to the working. Of course, it gives its challenges also of employment, but the good thing is that it keeps on adding people to the working class, which contributes to the growing economy. And the ballooning and consuming middle class is also a very important factor. By few estimates, by 2030, one in every two household will be an upper middle class, so moving out of the poverty. And what it does is basically that once you move to a middle class, then your needs are moving from necessity to the discretionary spending. So whether it is a mobile phone or whether it is a TV or a travel, which all again keeps on keeping the economy little recession proof, because a huge population is already consuming in the country. The other factor again is being already talked about a lot everywhere is China plus one, whether it was because of COVID policies of China or because of the tensions and the supply chain. Today, many companies are shifting their base to India. We work with many Japanese companies, and I know there have been large number of Japanese companies who are invested in China, but today they are looking at India, Vietnam as the alternate to China for having the establishment. Foxconn, Apple, there are every day we keep on hearing news about companies who are setting up base in India and trying to reduce their dependence on China, which basically again helps the India as an economy. I think you've already spoken about the startup ecosystem. Just to say what it actually help is that when you have such a big entrepreneurial startup ecosystem, what it does is that once the companies reach Series B, Series A, Series B stage, they become a very good candidate for the foreign company to make acquisition. And these companies are also in turn looking for strategic partners. We keep on getting inquiries where people come to us and say that we have reached level, we have raised our funding, but now we're looking from a strategic partner from Germany, whether it's on the EV side, whether it's on the technology side, Japan, Taiwan. So the requests keep on coming from startups who either want to sell or at least want to have a strategic partnership with the overseas partners. So that's one of the very important factor which is helping India as an economy. I think major thrust on infrastructure. We have election coming next year, but in respective of that, I think last few years, whether you talk about the speed at which the highways are getting constructed, or if you talk about the Udan policy, where every tier 2, tier 3 cities is going to get a big airport. If you talk about bullet train is more of a gimmick, but if you talk about the high speed train, the Vande Bharat trains, every day there is a news about 200 trains coming next year. So there's a lot of focus by the government to spend on infrastructure. And what basically does it that infrastructure helps you have a good supply chain management. The goods can move with a breathtaking speed. There was a huge amount of good food items which used to get, or they're still getting, get wasted because of not of a good cold chain supply. Infrastructure definitely helps you to have a system which helps the economy keep going. Ease of doing business. There's a World Bank ranking. We should not be very proud of it, 63 out of 190, but India stands at the 63 position. But what is more important factor is to look at that India has moved 67 places in last 3 years in terms of ease of doing business in India, which is a very, very big indication to the investors that government has its mind in the right place. GST was introduced many years back, in which almost 17 laws were kind of combined into GST. IBC is there. Then you have various labor codes are almost notified. Your government is waiting for the right moment to announce that. All these regulations are making India as a very, very strong investment candidate in Southeast Asia, or I would say in the world at large, for a foreign direct investment. Next slide, please, Leah. Once you've decided India, you've decided, okay, it's India now, it's very important to build your go-to-market strategy. How do you enter into India? What's the key factors you have to look at? And these are true for investing into any other country, but there are certain nuances which we would like to talk about, which are very peculiar to India. And the first being that one should view India as an EU, with 28 countries. India has more than 28 states and union territories. What it does is that while there are common laws and there are GST and federal laws are common, the culture of doing business is very different from a North India to a East India to a West India and a Southern company. So the way they conduct business, the language is different, the food is different, the tastes are different. So once you are investing into India, you need to identify which part, because for example, if it's a company which is looking at a huge export making India as a base, then a proximity to the coast, the proximity to a port, which is west or south, becomes more relevant. So it is important to study India as to which state serves your purpose as far as the M&A is concerned. Then the next important factor is to understand the culture. Now, culture, when I say culture, it's, India is, people are a little polite by nature. When they say yes, it doesn't always mean yes. We by nature are not straightforward to say no. So it's very important to understand and read between the lines. The most important factor which comes is that if you approach anybody, and today if I call somebody and say that, listen, I have a interest from a Japanese or a French company to buy 80% or 100%, it's a very difficult conversation to have because people are not yet open to the mindset to sell. Forget selling majority. India has not reached that level where people are, of course, it's going there and people are realizing that it's important to have, succession planning and important to have, but still it's a family driven culture where selling stake is being considered as something negative for the market. If somebody is selling stake means, oh, there's something wrong with this guy, he is not doing well. So it's very important to understand the culture when you approach these sensitive matters. And the related point to that is to build strong personal equations. India is a very, very, like any Southeast Asian country, very people driven market. Most of the businesses are family driven, where a head of a family would have a very important say in the decision making. So it's very important to know which are the relevant people, and it is important to build your personal bonds with them. It's not clinical to send an email, do a call over a Zoom. Come to India, spend some time, have dinner, invite them to your country. That's the way, is the right way to build strong long-term partnerships with reliable partners in India. Goes without saying, it's very important to understand the regulations, and I'll talk about regulations subsequently, but largely important to understand what are the rights of a majority partner. Are you looking at 51? Are you looking at 75? Are you coming to India as a minority partner? What kind of a percentages you need to look at? What are the FEMA regulations on the valuations you have to look at? So regulations is very important to understand. Trust but verify. When I say trust but verify, it is linked to the cultural issue that, people here are very, very nice. When you meet them, it's very, very nice, but you need to be doing your diligence very, very thoroughly, and diligence both before making an investment decision and when you are in the process of discussion investment. It's important to do your background checks, reputation checks. Also important to put everything in writing. The importance of having a term sheets or LOI is very, very important, because people do have sometimes a tendency to go back. Okay, this was not discussed. We would never discuss it. So make sure that whatever is agreed, at least important things are minuted and documented, so that there is no bad taste once you reach a final stage in the negotiation on a transaction. And last but not the least, is important to have advisors early in the process. Frankly, I've seen many companies who come to India, they have past experience of dealing with somebody, either they were doing some kind of a trading with them, then they start, why don't we do an M&A? Then they would make some commitment, and by the time they would appoint an advisor, they realize that they've committed something which should not have been committed, or something which actually does not, your regulations do not allow you to commit certain things. So it's important to have your financial and legal advisors absolutely right time in the process, as early as possible. Is the right time to advise them. Next slide, please, Leah. Now, what are the key considerations while you're doing an M&A in India? And again, these are the considerations which will apply largely to any geography, but there are certain peculiarities about India which a foreign investor need to take care of. With the first importance being the deal structure. Now, when I talk about deal structure, the easiest structure and the most common structure is a share purchase. You just buy the shares of a company and make it a subsidiary, but then you have a risk associated with the past long history, whether it's litigations or tax issues. Or sometime if you have a company in which has two divisions and one of the division is non-core for your business, then people are today relying more on structures like slum sales, business transfers, asset transfers. What it also does, it takes care of in the past litigation. You don't have to worry about the past history, because then you are trying to buy a cherry picking the assets which you really want. Of course, this all has to be done in consideration with the tax implication of that deal structure. So deal structure is extremely important to at the beginning of the transaction, because then your entire diligence and your entire valuation, entire tax depends on what kind of a structure you are contemplating from the day one. The next important issue is the understanding of the business projections and valuations. Now, in India, while any seller would make a aggressive business plan, we are mostly as an, I would say, highly optimistic, or people who would make a very, sometimes it's also because they don't know how to make a business plan or a business projection. They would submit a business projection and then they start getting attached to it. Okay, my business will double or triple in next 2 years, and hence I need the valuation related to that kind of a business. So that's a tricky part of the whole thing. And the best structure to do that is, one, either you go for an earn out, which is earn as you go, or you go for an escrow mechanism. There's a regulations involved in escrow, but you can put some money, withhold some money, which can be linked to the future performance of the business, which will be only paid once those business projections are met or achieved. I have already talked about diligence, but to talk about diligence a little bit more, pre and post LOI diligence is extremely important. Pre-LOI would be more desktop diligence, where you just do a reputational check, whether the company has a strong reputation, whether they have not defaulted, they have no legal cases, criminal cases. So that can be done by the advisors who will do a desktop or a background reputational diligence for you. But more important is the post-LOI diligence, where you have to do financial tax diligence to understand the quality of earning. And why it is important is that most of the companies in India are family-driven companies, and for tax reasons, for tax optimization, you will see that many of the personal expenditures would have been booked as a company. There is no differentiation between a personal and a corporate expense. And when you reach a stage of valuation or the M&A, you need to identify what is the real sustainable profitability or the EBITDA of the company. So it's very important to do a thorough financial and tax diligence post LOI stage, so that there's no surprises once you are at the consummation. The other important factor is tax and regulations. I think on the regulation side, the most important regulation which governs a foreign direct investment is a foreign investor and M&A is the FEMA regulations. As per FEMA, if a non-resident is investing into a share of a resident company, it has to go through a FEMA valuation. If you're selling, an Indian is selling, that FEMA price becomes the floor. On the contrary, if a foreigner is selling, if it's exiting, it becomes the cap. Now, this is very important regulations which needs to be thoroughly understood, because otherwise you would be standing on the wrong side of law. So FEMA is one important, but more important are the tax related matters. We'll talk about that, but ultimately, if you are going for a structure which is a tax inefficient structure for the seller, eventually he will ask for more, to compensate you for that tax inefficiency in the structure. Similarly, if you are going for a royalties, or after the investment, the foreign company is asking for a royalty or some, there are TDS issues on royalties. There are double tax avoidance agreements which you need to be very careful of as a jurisdiction from where you are investing. So tax is an extremely important area which needs to be kept in mind ready from the beginning of the transaction. Another issue which is very common to the most of the Indian companies, which are family companies, are the related party transactions. Sometime to manage taxes, they will have a couple of companies in which the business is being done, or the relatives are being the vendors or the suppliers. Now, as long as there is an arm's length long-term pricing, it's not a concern. But if, as an investor, you feel there is an uncomfortable situation on any related party transaction, then one needs to make sure that as a condition precedent to the closure of a deal, or a condition subsequent to a closure of a deal, these related party transactions needed to get to be regulated or stopped. So that's very important, and it's very peculiar for a small, mid-size, or I would say family businesses in India. The other important thing is on the understanding the reporting and the accounting standards. In India, a company which is less than 250 crore net worth, which is roughly 30 million US dollars, need not follow an IFRS. So India has its own accounting standard called Ind AS, which is very similar to IFRS, but it's only applicable if the companies have the net worth of $30 million and above. So if you're doing a transaction with a company which is a family-driven company or a mid-sized company, the chances are that the net worth would be less than 30 million, which means they don't need to follow IFRS. What it does is that the disclosure requirements under the Indian GAAPs are relatively lower than what maybe an investor's company in IFRS would be. There are differences as to how a lease has to be accounted. There are differences how as to a real value of our assets has to be declared. So it's very important for you as a foreign investor to understand what are the differences in the Indian accounting standards and the IFRS once you are making a final decision as to what's the real reportable profit. Because ultimately, if you consolidate, it has to ultimately be as per as the IFRS reporting standards. The other important factor is the responsibility of an executive or a resident director. So if a foreign investor is coming into India and investing, And the idea is only to attend 4 board meetings and not to be involved in day-to-day running of the business. It is strongly advised that the directors become a non-executive directors. While all directors have an equal responsibility for acts of the company, but the executive directors or the whole-time directors or the resident directors are the one which are the first in the line if there are any compliance issues, etc. So if a director from a investor company is not supposed to be involved in day to day, we highly recommend that they classify themselves as a non-executive directors. And last but not the least is the PMI, post-merger integration related issues. Again, mid-sized Indian companies do not have the habit of making a monthly reporting or monthly MIS. And it's again a cultural issue. Once you tell them that, okay, you have to submit your accounts in a particular format every month, it's a mental challenge and it's a roadblock. So it's important that from the beginning, these issues regarding, what will happen post the transaction, how a consolidation will happen. Many Indian companies follow March end, but European companies or American companies mostly have a December year end as a financial year. So if you have to make shift of a consolidation, then December has to be closed. All these small issues become big in the end. So it's very important to have very strong discussions on the PMI related issues once you are doing a transactions from cross-border or overseas transaction. Next slide, please. So last this slide, I want to talk about a little bit about the regulations. While many regulations are there, I've just kept few regulations which directly impact the decision making. All the companies in India are governed by the Companies Act 1956. What is important is to understand the rights and obligations of investors in a different scale category. So if in India there are two major thresholds. One is your 51%. As a 51% investor, you get a lot of rights. But as a 75% investor, you get absolute right to pass most of the resolution. Of course, the minority would negotiate for reserve matters, etc. But by law, if you hold 75% share, you can do almost all the activities, major decisions without taking minority into consent. Which flip side means is that if you're coming as a minority investor in an Indian company, it is important to have 25% plus one share or 26% so that you have your minority protections right by law. So Companies Act is very important for any investor to understand the rights, etc. under the law. Other is the FEMA. I've already spoken about Foreign Exchange Management Act. Valuations of any foreign investment are governed by FEMA. One needs to respect those valuations. When you are negotiating a valuation, it is important that a check is done that whether that valuation which is being negotiated for the M&A transaction fits in the budget of the FEMA Act also. Income Tax Act, I've also briefly spoken about, but again, very, very important to understand the tax implication, whether you can repatriate dividend, what will be the implications on that, what is the tax avoidance agreements, which you have double tax avoidance agreement with your jurisdictions, what will be the tax implication on the valuation. There are section 56, 11 UA valuations under the income tax. So FEMA has its own set of valuations. Income tax has its own set of valuations. So it's very important to understand that you are not on the wrong side of law, because then it becomes income in the hand of the company if it's not done as per the Income Tax Act. So valuation, your tax implications, tax on the transaction, repatriation, very, very important to take care of the regulation under the Income Tax Act. If you are investing in a listed company in India, you have to follow SEBI regulations. There are regulations on how you arrive at the pricing as per SEBI. SEBI stands for Security and Exchange Board of India. So you have to take care of those regulations. If the plan is to become a listed company after acquisition, then very important to understand what are the disclosures. There are a lot of disclosures which a private or a public company need not make, but a listed company needs to be making. So very important to understand the SEBI regulations. FDI is very, very important. Although today, as we speak, most of the sectors, there is 100% free FDI, but there are still sectors where there is no FDI involved allowed. For example, the nuclear energy, your lotteries, tobacco, etc. There is no FDI which is allowed. There are sectors in which FDI is allowed, but with government approval. For example, if you're investing into defense, up to 74% you can make an acquisition, but beyond that, you cannot take without a government approval. For example, in media, it is 26%. So FDI regulations are extremely important for us to understand whether it's completely allowed or not. And last is the competition. If it's a mega transaction, it's just akin to an antitrust. So if it's a mega transaction and it relates to a monopolistic situation, you need to evaluate from a company's competition law perspective also. So there are many other laws like labor laws, etc. But these are few regulations which are very important to take care of right from the beginning and also through the process of the M&A transaction before you consummate the transaction. I think this was the last slide. Thank you very much, Leah. Thank you. Over to you.
Thank you very much, Nitin. Thank you, Louisa, as well, for taking us into the unicorn world and why the companies should capitalize on the local startup and the scale-ups. Thanks, Nitin, for taking us like first why a company should choose India, what are the M&A trends in the country and the key consideration in the cross-border transaction. So we will now start our Q&A session. So I am inviting the audience to please put a question in the chat box if you have any question, comments, and we will take them up. So first, Nitin, I have one question for you, which would be, how long does it typically takes to close a transaction in India from the start to the end?
So, if it's a cross-border transaction, I'm assuming you are asking a cross-border transaction. It typically, it depends if you have identified a partner or not. So if the partner is not identified and you mandate somebody to find the right partner in India, it typically takes a year, sometimes 12 months to 15 months to close a transaction. But if most of the time, we have seen that investors have already a partner identified with whom they have past relationships, and they want us to advise on the complete life cycle of a transaction, then it typically takes 9 months to 12 months to close a transaction. I'm talking from valuations, negotiations, due diligence, paperwork, closing formalities. Private equity transactions are faster; they happen in 3 to 6 months. But strategic M&A transactions take typically 12 months to close a transaction.
Okay, thank you. There is one other question that would be for you as well, I believe. Is there any valuation method which is more commonly used for transaction in India?
There is no method which is prescribed by any law. Earlier in FEMA, there used to be DCF. I'm talking many years back. FEMA used to prescribe only DCF, but many years back the law has changed. That I'm talking more of first regulatory, and then I come to answer your question. As per regulatory law, you can use any valuation methodology which the valuer deems fit as per the arm's length pricing, which means you can do anything. However, for startups, I have seen the discounted cash flow method is most commonly used because they have very limited history. So their valuations are mostly dependent on the projections and the business plan. But for a traditional old economy company, which is more established, I have seen market multiples, which is your comparable companies and comparable transaction multiples. You use many other methods, but for an established company, a multiple of profit or revenue is more commonly used versus a DCF for a growing company, basically.
Okay, thank you very much. Now, Louisa, I would say it's a question more for you. Someone is asking at what stage a startup would approach advisor like us. What's the time to do that? How to manage that?
I think that a startup which is just at first phase of its own expansion, it is probably too early to realize acquisition, mergers, or to look for example, to a cross-border transaction, for the reasons why that you need to buy a startup need to create its own identity before going outside. There is some exceptions inside that. You can have in the European ecosystems, you have some startups that are able to be supported by very large local funds. So they are very well funded since the beginning. And so in that case, I would say immediately after the funding, the startup would be able to leverage your support, but are essentially startups which has funds behind.
Okay. Thank you very much. Another question is coming and would be how to identify, I mean, the question can be for both of you, I believe, how to identify the appropriated partner in India?
Louisa, I think you should go first.
That's a
It's
difficult
a very
question.
good question, very interesting. I can write a book on that, maybe one day. But I honestly, I have very, very positive stories. But yeah, the partner in the transaction and the investments that I consider it as it depends first of all on the transaction and what we need. For example, if you want to realize an exit of assets in India in specific sector which require a very, very hands-on approach, you will find probably some small boutiques which knows the industry. I'm speaking, for example, about education, I'm speaking about healthcare. Sometimes you have assets in India and after years of holding these assets, you need to exit. And so in that case, you have to find very specific teams. And when the transaction is small, this is better. When the transaction is larger, in that case, firms like yours could be more suitable for a larger transaction, which not requires a day-to-day follow-up of the clients. Because sometimes you have some foreign clients, Europeans, that have assets in India, but they want to exit, but they need a day-to-day work for several reasons, because the local partner was not smart. So they need advisors that help them to do the day-to-day work in terms also of executing some part of the transaction. So it's a sort of outsourcing the execution outside their own headquarters. This is what happens. After that, if you have more traditional transactions in which a French scale-up needs to acquire a company in India, this is clearly you can go to an investment bank, to a company like yours. It depends also to the technicalities that are required. So my advice is that each transaction has a different should be executed by different advisors in India, depending on the peculiarity of the transactions. And honestly, the one point is important. There is a very limited number of advisors that know Europe from India standpoint, and could be a challenge for a European company. What I mean by that the major part of the Indian landscape knows United States, knows California, because historically is the I would say the experience. But we have in Europe a limited number of brands from India, advisory brands, financial brands, asset management brands that knows Europe and then can help to build this bridge. So it's the cross-border is cross-fertilization, means that we go to India, yes, for sure, but also when we are in Europe, the visibility that exists in the Indian brands in your space or in another complementary space is more limited, with the exception of UK, in which traditionally you have an historical legacy. But we know each other, for example, with DASA, because we know each other in daily essentially, and then we expand our relationship. This is an example.
Thank you very much.
So this is the
Sorry.
point. Yeah.
Okay. Nitin, anything you want to add on that?
No, I think Louisa has covered it well. I would just say, if you don't know a partner, you appoint us as a partner to find a partner.
Yes.
Right. Okay, so I don't have any further question. So I think we can wrap up the session now. So thank you again, Louisa and Nitin, for sharing your expertise from, I would say, both sides of the table. And thank you for this very lively and interesting session. Thank you also to all the audience for joining online. So as mentioned in the beginning, we will share with you tomorrow the summary of the session as well as the link to the recording. And if you have any further question to that, you can definitely reach out to us by email after tomorrow's mail. Thank you very much, everyone, and wishing you a very happy day ahead.
Thank you.
Thank
Thank you
you.
very
Thank
much.
you.
Bye.
Bye.
Bye. Thank you. Bye.